welcome to the research desk. In 2008, roughly $10 trillion in global wealth just vanished.
Yeah, completely evaporated.
Right. And it didn't vanish because of a war or, a geopolitical shock or a natural disaster. It vanished because of a single, highly contagious mathematical assumption.
Which is terrifying when you really think about it. One equation.
Exactly. It was the assumption that a housing market defaulting in Florida had absolutely nothing to do with a housing market defaulting in Nevada. And this assumption was codified into what I consider the most dangerous sentence in modern finance.
Oh, I know the exact sentence you're talking about. Our portfolio is well diversified, correlations are low.
That's the one. Correlations are low. Today, we are examining the foundation of this catastrophic risk failure because the core issue lies in the standard mathematical assumptions of Pearson correlation, which, assumes linear relationships and normal bell curve distributions versus the brutal, nonlinear reality of extreme market events.
Right, because correlation is designed to tell you how two assets move together on average across all calm market conditions.
Yes, but in the tails, the extreme 1% of trading days that determine whether an institution survives or liquidates, standard correlation is just structurally wrong.
It falls apart completely.
It really does. So the mathematical tool that reveals this fundamental flaw is called the Copula. It's derived from Alfred Sklar's 1959 theorem, which isolates the pure dependent structure between random variables, entirely separated from their individual behavior. I will argue today that adopting the correct dependent structure, specifically the Clayton Copula, is the only mathematical way to accurately measure and survive tail risk.
And I will argue that while copulas are a sharper lens, relying on them introduces a highly dangerous illusion of precision. You get severe parameter instability. So while the mathematical elegance of Sklar's theorem is unquestionable, and the destruction of 2008 is a matter of historical record, my perspective centers on the practical reality of execution.
Okay, let's hear it.
Well, Sklar's theorem is settled probability theory. It brilliantly allows us to decouple the individual distribution of a single asset from its relationship with other assets. But the moment we attempt to drag this pristine theorem out of academia and apply it to live multi-billion-dollar portfolios,
You're saying we introduce noise.
we introduce severe parameter instability. Choosing a specific copula family, deciding exactly what shape a crisis will take before it happens, is inherently a subjective model assumption. We assume we have mapped the exact, precise contours of a future crisis, when in reality, we have simply fitted a highly sensitive new curve to historical noise. Treating a subjective copula parameter as an absolute truth can trigger a false sense of security that is just as fatal as relying on simple correlation.
I hear that. But before we debate the instability of the parameters, we need to ground exactly what Sklar's theorem achieves for the practitioner, because it fundamentally alters how we view risk.
Sure.
It allows for what I call a surgical extraction of risk. Every investor essentially faces a dual problem, right? First, how volatile is this specific asset in isolation?
The marginals.
Right, the marginals. And second, how will this asset behave alongside my other assets during a system-wide crisis? Standard correlation matrices blur these two highly distinct questions together into a single, opaque number.
They average it out.
Exactly. Sklar's theorem allows a crucial decoupling. We can break the joint distribution of a portfolio into its marginals. And let's clarify that term for a moment for the sake of the argument. When we say marginals, we are simply talking about the individual behavior of a single asset in a vacuum, completely ignoring the rest of the market.
Right. Just the asset on its own.
We separate those marginals from the copula, which is the mathematical linkage itself. By separating these two components, we gain the unprecedented ability to stress test the linkage independently. We can keep the volatility of the asset exactly as it is, but swap out the calm weather linkage for a severe crisis regime linkage.
Which is where the Gaussian copula sailed.
Spectacularly. Relying on the standard Gaussian copula is an architectural failure because it mathematically assumes tail independence. It hard-codes the assumption that extreme events do not cluster. So I advocate for the Clayton Copula because it accurately models the empirical reality of financial markets. Assets are highly likely to crash together.
I want to pause on your concept of a surgical extraction, because while the theory is pristine, the surgery itself is remarkably bloody in practice.
Bloody how?
Well, Sklar's theorem proves mathematically that a unique copula exists for any continuous joint distribution. That's true. But what it emphatically does not do is hand you the parameters of that copula on a silver platter. The choice of a copular family, whether it's Gaussian, Clayton, student T, whatever, is a purely subjective assumption imposed by the human modeler.
It's an educated structural choice based on market mechanics.
But we are immediately confronted with the stationarity problem. If you fit a Clayton copula to a 3-year period of market calm, you will yield an entirely different structural risk profile than if you fit it to a 6-month period of extreme market stress. The copula does not solve the problem of moving targets. It simply inherits it.
I disagree that it just inherits it. It gives you the tool to model the moving target.
But assuming that a Clayton copula fitted to the exact parameters of the 2008 financial crisis will perfectly model the dependent structure of, say, an algorithmic liquidity event in 2026, that implies a level of structural permanence that financial markets simply do not exist. You are treating a dynamic, evolving system as if it were a fixed physical law.
Okay, but to understand why we must risk that difficult estimation process, we have to examine the architecture of catastrophe. We have to move from the pure probability theory of dependence to its most devastating historical application.
You're talking about David X. Lee.
David X. Lee's formula from the year 2000. Lee published a paper that proposed using the Gaussian copula to model default dependence in credit portfolios. And the logic was incredibly seductive for Wall Street.
Oh, Wall Street loved it. It made pricing exotic derivatives trivially easy.
Right. You take each borrower's individual probability of defaulting on their mortgage, again, their marginal distribution, and you link all those individual borrowers together using a Gaussian copula parameterized by a single correlation number. By the year 2006, this exact mathematical formula was pricing virtually the entire $2.5 trillion collateralized debt obligation market.
The CDO market.
Yes, and the fatal flaw was built directly into the architecture of the formula. The Gaussian copula assumes zero-tail dependence. This means the model concluded with absolute mathematical certainty that a mortgage defaulting in Nevada had virtually nothing to do with a mortgage defaulting in Florida.
Even though they were being driven by the exact same macroeconomic factors.
Exactly. Because the correlation parameter was set artificially low based on historically calm data, the model calculated the probability of widespread simultaneous defaults across the senior tranches of these debt instruments at a vanishingly small 10 to the power of -9.
Basically impossible.
It assumed that geographical dispersion equated to tail independence, which is just a structural delusion.
Well, let us clarify exactly what tranching physically is, so we really understand how this math translated into a financial weapon. When a bank bundles 10,000 mortgages together into a collateralized obligation, a CDO, they slice that bundle into tranches or layers of risk.
Right, like a waterfall.
Exactly, a waterfall of cash flow and losses. The equity tranche at the bottom absorbs the first losses. If a few mortgages defaults, the equity tranche takes the hit, and the senior tranches at the top remain completely protected.
Which makes the senior tranches AAA rated.
Yes, but the entire viability of the senior tranche depends on correlation. If correlation is zero, meaning defaults are completely independent, it is statistically impossible for enough mortgages to default simultaneously to ever reach the senior tranche. It is deemed bulletproof.
But if they all default at once?
Right. If correlation goes to 1, if every mortgage defaults at the exact same time, the senior tranche is suddenly just as risky as the equity tranche. Now, the narrative that David Lee's Gaussian formula single-handedly destroyed the financial system is a misdiagnosis.
A misdiagnosis? How? It was the engine of the entire CDO machine.
This was not a failure of copulas generically. It was a highly specific misapplication of a specific mathematical assumption to a specific market that shared a massive, unmodeled macroeconomic factor. the national housing price cycle. When that cycle turned, the defaults naturally clustered.
Which the Clayton copula would have caught.
Perhaps. But replacing the Gaussian copula with the Clayton copula in 2006 would not have simply fixed the math. It would have destroyed the economics of the market entirely. If you applied a Clayton copula showing high lower tail dependence coefficients, the senior tranches would have been priced as highly risky. They would have been unprofitable to issue, and the entire CDO machine would have ground to an immediate halt.
Wait, you are accurately describing the mechanics of the market, but you are validating my core point.
How so?
The Gaussian copula was an active enabler of structural blindness. The fact that applying the correct mathematical reality, the Clayton copula, would have halted the market only proves that the market was built on a delusion.
Well,
Let me use an analogy to clarify the stark difference between simple correlation and the copula. Think of standard correlation as a weather average. It tells you that a specific coastal city gets 30 inches of rain per year.
okay.
That statistic is completely true. It is empirically verifiable. And it is entirely useless when you need to know whether the city will flood on a specific Tuesday in October during a hurricane. Standard correlation averages the calm days with the panic days.
I see where you're going with this.
The copula, on the other hand, is the drainage map. It shows you exactly where the water accumulates during a catastrophic downpour, which neighborhoods flood first, and which are structurally protected. The average rainfall did not change, but your understanding of catastrophic risk transforms completely. The Clayton copula provides the precise drainage map for the panic.
The drainage map analogy clarifies the concept beautifully, I'll admit. But let us extend that exact metaphor to highlight the danger you are introducing. The fundamental problem with your drainage map is that the terrain of the financial markets keeps changing.
The terrain changes, but gravity doesn't.
A pristine, highly detailed drainage map is worse than useless if an algorithmic trading shock just paved over the riverbed and redirected the water entirely. That is the stationarity problem in a nutshell. To understand why the Gaussian copula failed so spectacularly in 2008, we really must examine the alternative dependence structures available, what quantitative researchers call the copula zoo.
The copula zoo, right?
And we need to see how they actually perform against empirical reality. Each shape tells a specific story about market behavior, but none of them are permanent.
We do need to understand the structural differences between these models, because the Gaussian assumption of independence at the extremes is mathematically indefensible during a crisis. As we established, Gaussian is the baseline. As you move further into extreme standard deviations, the probability of joint extreme outcomes decays to zero.
Which we know is empirically false in finance.
Exactly. So risk managers look for alternatives. The immediate step up is the student T copula. This introduces symmetric heavy tails. It acknowledges that extreme events happen more frequently than a normal distribution suggests, but it assumes symmetry.
Meaning, it assumes crashes and rallies behave the same way.
Right. It assumes that extreme market crashes and euphoric market rallies are equally likely to cluster. But anyone who has traded through a cycle knows that markets panic very differently than they party.
That's the old Wall Street adage. Markets take the stairs up and the elevator down.
Precisely. Panic is highly correlated. Euphoria is often isolated. This brings us to the Clayton copula, which concentrates dependence almost exclusively in the lower tail. It states mathematically that assets are highly likely to crash together, but they do not necessarily rally together.
But the Clayton copula is entirely useless if the market is experiencing a massive synchronized bubble. What if the systemic risk is not a crash, but an explosive, coordinated melt-up like the dot-com bubble of the late 90s? Clayton can't model that.
Exactly. Which is why risk managers switch to the Gumbel copula. The Gumbel is mathematically designed to map euphoric upper tail clustering and momentum synchronization.
So Gumbel is the bubble copula.
You could call it that. And if we want a model with no tail dependence but symmetric moderate dependence in the middle of the distribution, we use the Frank copula.
Okay, but what if you need both?
If we require the absolute highest level of precision, we look to the Joe Clayton symmetricized copula, or SJC.
It handles asymmetric tail dependence in both directions simultaneously, allowing us to specify exactly how assets cluster in a crash versus how they cluster in a bubble. It gives us a completely different drainage map for a flood versus a drought.
Look, defining the structural options in the zoo is necessary, but the danger lies in the confidence with which a quantitative team selects a single model to govern billions of dollars of exposure. The devastation of 2008 illustrates exactly why the Gaussian assumption was lethal, but it also highlights the extreme volatility of the underlying dependent structures themselves.
Well, let us look closely at the devastating statistics of that exact empirical reality, because the numbers are just staggering. Between September and November 2008, cross-sector Pearson correlation in the S&P 500 surged from roughly 0.4 to 0.85.
Which is a massive jump.
It is. That is a 2.1 times increase. A traditional risk manager looking at that standard correlation metric might conclude that their diversification has been cut in half. That is painful, but, manageable. However, that manager is completely blind to the tails.
Because correlation averages it out.
Yes. During that exact same 2-month window, Clayton lower tail dependence jumped from 0.15 to 0.65. That is a 4.3 times increase. The tails moved more than twice as fast as the averages.
A 4.3x jump in tail dependence. Wow.
The portfolio that looked moderately diversified in calm seas was aggressively, fundamentally concentrated in the storm. The drainage map revealed that all the water was flowing into the exact same basin.
The asymmetry in those numbers is stark, I'll give you that. I do not dispute that the tail dependence accelerated far beyond the standard linear correlation metric.
But we must look at the value at risk discrepancies to see the actual physical financial impact on a trading desk.
Let's hear the VAR numbers.
At the 99th percentile value at risk, which measures the maximum expected loss over a specific time frame, applying a standard Gaussian Copula to a multi-asset equity portfolio estimates extreme losses of roughly negative 3.2%. A Clayton Copula fitted to that exact same underlying data estimates negative 5.1%.
And the actual observed loss?
The actual historical loss observed at that percentile was negative 5.3%. The Gaussian model systematically underestimates tail risk by approximately 40%. But the truly catastrophic failure, the failure that actually destroyed institutions, is found in joint probabilities.
The probability of everything tanking at once?
Right. If we calculate the probability of multiple, seemingly uncorrelated assets simultaneously breaching their 10th percentile, a joint 10% drawdown, the Gaussian model estimates a 0.1% probability. The Clayton model estimates 2.4%. The actual observed frequency during the crisis was 2.1%.
Wait, let us pause on that number and ground it in the reality of what it means for an institutional trading desk. You are stating that the Gaussian model estimated a 0.1% probability and the actual frequency was 2.1%.
Yes.
The standard model was not just off by a few basis points. It underestimated the risk of a total synchronized portfolio collapse by a factor of 20.
Exactly. Not 20%, 20 times. If your mathematical model dictates that a catastrophic firm-ending loss should only happen once every 1,000 trading days, and it actually happens 20 times in that same window, your risk management system is not just flawed, it is actively hallucinating.
That's a strong word, but accurate.
And that exact hallucination is why a $10 trillion hole was blown in the global economy.
The hindsight precision of the Clayton's Copula perfectly explaining the 2008 collapse is mathematically undeniable, I grant you that. But projecting these specific parameters forward into live trading environments where the future is entirely unwritten is a completely different intellectual exercise. This brings us directly to the estimation difficulty and the profound illusion of precision.
Here we go.
You cite a Clayton estimate of 0.65 for lower tail dependence as if it is an immutable law of physics, something you can just engrave in stone. But we must discuss the severe confidence intervals surrounding these estimates.
Clarify what you mean by confidence intervals in this specific context, because understanding the margin of error is critical.
The confidence interval represents the range within which we can be reasonably sure the true number actually lives, given the limited sample of historical data we have. Financial data, especially extreme tail event data, is remarkably sparse.
Because crises are rare.
Exactly. You simply do not have thousands of daily market crashes to build a robust sample size. Because the data is so sparse, a Clayton estimate of 0.65 might easily have a massive confidence band spanning from 0.45 all the way up to 0.80. The quantitative analyst or chief risk officer who takes that midpoint of 0.65 and treats it as an absolute truth is making the exact same epistemological error that the Gaussian Copula users made. They are confusing a highly sensitive, volatile model output with physical reality.
But recognizing a wide confidence interval does not invalidate the structural superiority of the model itself. Knowing that tail dependence exists somewhere between 0.45 and 0.80 is infinitely better than using a Gaussian model that insists tail dependence is mathematically zero.
It invalidates the certainty with which capital is deployed against that model, and we have not even touched on the complexity scaling, which is disastrous.
You mean going beyond two assets?
Yes. We've been discussing bivariate copulas, comparing exactly two assets or two sectors. Bivariate copulas are mathematically manageable. A two-dimensional grid is easy to visualize. Real institutional portfolios, however, contain hundreds or thousands of individual assets.
Right.
Modeling high-dimensional dependence across 500 stocks requires incredibly complex hierarchical structures, known as vine copulas. You are taking hundreds of these two-dimensional grids and linking them together in massive, intricate trees.
Vine copulas allow us to build up the entire dependency structure pair by pair. It is mathematically intensive, yes, but it scales the theory to the portfolio level.
It buckles under the weight of its own complexity. The dimensionality curse here is profound. I point to the comprehensive research by Zhao and colleagues, published in 2018. They demonstrated clearly that fitting different hierarchical vine structures, choosing a canonical vine versus a drawable vine, to the exact same set of market data produces materially, wildly different risk estimates.
Different structures yield different shapes, sure.
But when you introduce layer upon layer of modeling choices to build a 500-asset vine copula, the pristine elegance of Sklar's theorem completely breaks down under the weight of practical intractability. You are piling assumptions on top of sparse estimations, on top of subjective structural choices. You end up with a model so complex that it obscures the very risk it was designed to illuminate.
I accept that the computational weight is immense, but demanding perfection where profound improvement is already available is a mistake. Let me introduce another way to frame this estimation precision. Let's call it the chain analogy.
Okay, let's hear the chain analogy.
Standard Pearson correlation measures the average strength of a metal chain by testing every single link under a moderate, everyday load. It averages the data and concludes the chain has an average strength of 8 out of 10.
Fair enough.
The copula, specifically a lower tail Clayton copula, ignores the average and tests only the weakest links under maximum catastrophic load. Now, if the 3 links at the center of the chain have a strength of only 2 under extreme tension, the entire chain will snap.
Right.
The Gaussian copula assumes all links weaken proportionally and independently. The Clayton copula fundamentally assumes the weakest links fail together, catastrophically, in clusters. Now, if our estimate of the weakest link's failure point has a wide confidence interval, say our quantitative team estimates the breaking point is somewhere between a strength of 1.5 and 3.5, isn't that imprecise estimate of failure still structurally infinitely more valuable than a highly precise measurement of average strength that tells us the chain is perfectly fine right up until the exact millisecond it shatters?
The chain analogy is powerful, but your imprecise estimate is only valuable if the institutional risk system explicitly acknowledges the imprecision. If the risk system takes the midpoint of your weak link estimate and automatically optimizes a multi-billion-dollar portfolio against it without human override, you have optimized for a mirage.
You need human judgment, absolutely.
But we must connect these historical estimation difficulties to the modern market microstructure, where rapid structural changes demand even more dynamic models. This is the absolute wild card in our discussion: algorithmic contagion and regime switching.
The structural shift in the market is exactly why we must abandon standard correlation. We are no longer trading in the manually executed, human-driven markets of 2008. Currently, roughly 70% of United States equity volume is strictly algorithmic.
It's machine trading machine.
Yes. The implication for tail dependence is profound and immediate.
because quantitative signals and algorithmic execution engines often share very similar risk-off triggers, cross-asset contagion is structurally increasing. We are seeing elevated tail dependence between asset classes that were historically assumed to be completely uncorrelated: equities, corporate credit, commodities, and even cryptocurrencies.
Ground that in a specific market event for the listener. How does algorithmic execution physically alter the dependence structure?
Consider how modern volatility targeting works. When market volatility hits a specific quantitative threshold, algorithmic funds are hard-coded to automatically sell off risky assets to reduce their exposure.
Right, they degross.
Yes, if equity volatility spikes, these algorithms instantly sell equities, which causes further price drops. But they also sell liquid commodities and credit instruments to raise cash. The historical assumption that equity and commodity tail dependence was low relied entirely on the fact that those distinct markets had different human investor bases and different information sets.
They were siloed.
Exactly. Today, the exact same systematic strategies drive positioning across all liquid asset classes simultaneously. We saw this vividly during the massive liquidity shock of the March 2020 crash, where equity, credit, oil, and gold all sold off in terrifying unison. We saw it again during the United Kingdom gilt crisis in September 2022, where stress in sovereign bonds instantly infected pension fund equity holdings.
The doom loop.
Quantitative signals drive simultaneous, indiscriminate liquidation. Historical correlation calculated over the last 10 years is even less reliable today than it was 2 decades ago.
On the specific point regarding the speed and contagion of modern markets, we are fundamentally aligned, though I escalate the conclusion far beyond your position.
How so?
The structural shift you describe is exactly why static copulas, even the lower tail Clayton copula you championed earlier, are effectively dead instruments.
Dead?
Dead. The research by Bicuras and colleagues in 2015 on the dependence between oil and gold proves this definitively. They rigorously documented that copulas themselves actually change shape across different market regimes. It is not merely that the numerical parameters shift slightly, the entire structural copula family changes.
You were referring to the transition from symmetric dependence to extreme lower tail concentration.
Exactly. In a low volatility, calm market regime, the dependent structure between assets is Frank-like, meaning it is symmetric, moderate, and generally independent at the extremes. But the moment the market enters a crisis regime, the underlying mathematical structure violently shifts to become Clayton-like, concentrated heavily and dangerously in the lower tail.
The shape mutates.
Yes. This means the dependent structure is not a fixed architectural feature of the market. It is a highly volatile random variable itself. Therefore, hard-coding a static Clayton assumption into a risk model today is just fighting the last war. A hidden Markov model regime-switching copula framework is the only mathematically sound approach to modern markets.
The hidden Markov model sounds incredibly dense. Let us provide a clear, mechanical intuition for what that actually does to a portfolio.
Okay, instead of using one static, unchanging map for the market, the hidden Markov model functions much like a car's automatic transmission.
I like that.
It constantly monitors and detects the underlying road conditions. Are we cruising in a low volatility calm, or have we suddenly hit the ice of a high volatility panic? Based on state variables, it shifts the portfolio's mathematical gears instantly, moving from a Gaussian or Frank copula in peacetime directly into a Clayton copula during a shock. The hidden Markov model identifies the regime, and the copula identifies the dependent structure strictly within that specific regime. Together, they form a dynamic, breathing picture of risk.
I fully accept the necessity of regime-switching models. It represents the absolute frontier of quantitative risk management. But let us bring this deep theoretical debate into practical portfolio construction. We must synthesize the complex math into actionable reality for allocators.
Agreed.
If we converge on a core operational philosophy today, it is this. Standard correlation is a peacetime statistic. Copulas are wartime truth.
Peacetime statistic, wartime truth. That's a great way to frame it.
Correlation effectively describes how your assets behave when absolutely nothing extraordinary happens. Copulas describe how your assets behave when everything extraordinary happens at the exact same time. And as we both know, the simultaneous occurrence of extraordinary events is the single scenario that threatens a portfolio's survival.
It's the only thing that matters in the end.
The gap we discussed earlier, the vast difference between a negative 3.2% value at risk under Gaussian assumptions and a negative 5.1% under Clayton assumptions, is not a mathematical rounding error. It is the exact physical distance between a firm's survival and a terminal margin call. It is the distance between a risk committee declaring the portfolio as well diversified and a risk committee executing immediate, desperate hedges.
I agree that the distinction between peacetime statistics and wartime truths is the most accurate framing. Consequently, the operational reality of diversification must be completely reevaluated in light of severe tail dependence. Most institutional allocators still operate under the delusion that they are diversifying effectively simply by spreading capital across different geographies or standard asset class labels.
Which is a mathematical illusion under conditions of severe tail dependence.
It absolutely is.
So, to make this abstract concept concrete, consider the operational reality of a local business owner. Imagine an entrepreneur operating 5 different restaurants in 5 completely different neighborhoods across a massive city.
Okay.
Historically, the revenue streams of these 5 discrete locations show a very low correlation to each other, perhaps a Pearson coefficient of 0.3. Under standard Gaussian assumptions, the probability of all 5 restaurants experiencing a catastrophic month simultaneously is deemed negligible, roughly 0.1%.
So the bank loans them the money.
Exactly. The entrepreneur's bank looks at the traditional correlation matrix, approves the expansion loan, and declares the business highly diversified. But if we apply a Clayton Copula fitted to severe recessionary data, we see a lower tail dependence of 0.55. The probability of simultaneous distress jumps to 2.4%.
Because the macro cycle hits everyone.
Why? Because severe recessions hit all geographic locations simultaneously. True diversification cannot be achieved by geography alone. It must be achieved by demand driver.
Extend that to explain exactly how the entrepreneur should actually diversify to survive the tail event.
To actually break the common macroeconomic factors driving tail co-movement, the business owner must diversify fundamentally. One location positioned near corporate offices, relying on lunch traffic, one in a tourist district relying on weekend travel, and one entirely focused on automated delivery logistics. This fundamentally alters the economic linkage and the underlying demand drivers, rather than just mathematically hoping that physical geographical distance protects against a systemic macroeconomic shock.
That is the precise operational takeaway, and it applies directly and urgently to institutional portfolios. Allocating a massive fund across European equities, United States equities, and Asian equities provides almost zero actual protection in a global algorithmic liquidity shock, because the lower tail dependence across those supposedly distinct geographic equity markets approaches a perfect correlation of 1 during a crash.
They all go down together.
You must diversify across fundamentally different economic drivers, such as capturing a volatility premium, utilizing systematic trend following, or deploying truly uncorrelated macro strategies to survive the inevitable clustering of failures.
This leads directly to the most critical investable insight of our entire discussion. Because the vast majority of legacy institutional risk systems are still heavily relying on Gaussian models, or at best symmetric student T models, they systematically underprice extreme tail risk.
They simply do not model asymmetric lower tail dependence.
Therefore, financial instruments specifically designed to protect against simultaneous crashes, such as basket put options, correlation swaps, and dedicated tail risk funds, are structurally underpriced by the broader market.
Explain the mechanics of a basket put option briefly to illustrate exactly where the mispricing occurs.
A basket put option is a derivative contract that pays out massively if a whole group of stocks, a basket, crashes at the same time. The investor who utilizes a rigorous Clayton-based framework recognizes that a joint 10% drawdown across that basket has a 2.4% probability.
But the market doesn't see that.
Right. The broader market is pricing the premium of those options based on a Gaussian 0.1% probability. The market is selling disaster insurance far too cheaply because its own underlying risk model explicitly, mathematically denies that the insurance will ever be needed. This creates a massive, structural, and highly investable edge for those utilizing proper Copula frameworks.
I concede that the massive mispricing of basket options and correlation swaps exists precisely because of the pervasive, stubborn reliance on Gaussian assumptions in legacy institutional pricing models. If the market is persistently using the wrong map, the territory remains structurally mispriced.
Exactly.
We must synthesize our positions carefully here. We fundamentally agree that ignoring Copula dynamics defaults a portfolio to a blind Gaussian assumption. We both acknowledge that the Gaussian assumption of zero tail dependence is historically, empirically, and mathematically fatal.
It blew up the world in 2008.
It did. My standing objection remains the immense practical complexity of execution. Copulas introduce profound estimation challenges. High-dimensional vine copulas are computationally heavy and highly sensitive to subjective human structural choices. The parameters themselves are violently unstable across different market regimes. But I agree that despite these immense execution hurdles, attempting to mathematically measure the true brutal shape of the tail is vastly superior to closing your eyes and blindly trusting a standard Pearson correlation matrix during a liquidity crisis.
That is the ultimate synthesis of our debate. Finding the perfect, omniscient model is impossible. We will never map the exact, precise parameters of the future, but shifting one's operational philosophy from a simple correlation mindset to a rigorous Sklar decomposition mindset is paramount.
It's a required evolution.
Separating the crucial question of how bad can this single asset get in isolation from the infinitely more dangerous question of what is the precise likelihood that all of these assets collapse together is the single most important risk upgrade an investor can make. The Gaussian Copulas structurally denies that the worst-case scenarios are inherently correlated. It whispers a comforting mathematical lie. Yes, your individual assets can crash, but they will not crash together.
And Clayton tells the truth.
The Clayton Copula tells the deeply uncomfortable truth. They will absolutely crash together, and the clustering will intensify exactly as the crash deepens. The next frontier is real-time regime detection. We must dynamically adapt these dependent structures using advanced quantitative overlays like the hidden Markov model. We must recognize that the relationships between our investments are not static numbers. They are living, breathing entities that mutate aggressively under stress.
The unavoidable mathematical reality is that every single portfolio, every business expansion, and every massive capital allocation decision contains a hidden Copula assumption. The only question that matters is whether the investor has chosen that assumption consciously, mathematically, and rigorously, or whether they have simply inherited a fatal flaw by default. This is the research desk officially signing off.